So we've been talking about leverage. I'm going to go through a little bit more effort. This is primarily on financial leverage. And then at the end of this, there will be an assignment that I'm going to ask you to do, which is the format of which is contained in this lecture. So pay attention to the format that I've used here, and you'll also have the PowerPoint. You can go back and look at them. But you're going to do an analysis of a fictitious company and play around with the leverage, play around with the financial leverage, increase debt, increase equity, decrease equity, that sort of thing. So that's kind of what we're going to do. So financial leverage is composed of where I have, what kind of assets I have, both current and long-term, what kind of liabilities I have, current and long-term, how much equity I have. So if we play with these things, if we structure these things differently, we get different results. And the interesting part about this is that it has very little to do with operations. So you guys are in an operational master's program here. We're expecting that most of you will end up or already are in operations and operations management. And this is more on the finance side. So it may not be something you will do at any point in time in your careers, but it's certainly something you need to understand. So we're going to talk about that. So the first measurement of these components is the liquidity measure. So if we take current assets and divide by current liabilities, it tells us something about the liquidity of a company, their ability to pay their short-term obligations. The larger the ratio, the more assets relative to liabilities, the more liquid a company is considered to be. So we've talked about this earlier, but you'll see where we're going with this. This is a relatively short lecture, and I'm giving you some background, and then we're going to talk about what you're going to do for an assignment. So liquidity is the first thing that we look at when we're looking at financial leverage. How liquid is the company? Second thing we look at is solvency, survivability. And the primary measure of that is the amount of debt I have relative to the amount of equity. So debt to equity ratio is an important ratio. And here, the larger the ratio is, so the more debt I have relative to equity, is the higher the risk, which makes sense, right? And debt, at least the way we're using it, is going to be defined as total liabilities. So really, you could move debt out of that equation and say total liabilities divided by equity. So it's not just loans, but it's all my liabilities divided by equity. So that's debt to equity, and I think your textbook calls it debt of equity, but I think that's just a typo. It is debt to equity. And then a third measurement is how much am I earning on my equity? So stockholders have entrusted a certain amount of money to me. How well am I using that money to earn money? So how efficient am I in using my stockholders' capital? And that's called ROE, or return on equity. And here I'm going to take net income and divide it by average equity, which is beginning equity plus ending equity divided by 2. And the higher the percentage is that you get from this, the better the return. So how much equity am I provided with, and how much does that, how much can I earn with the equity that my stockholders have provided me with? So that's those three measures: liquidity, solvency, and return on equity. Those are important measures, and we can affect those measures with financial structure. So financial engineering, if you will, we can change those, and we can change them without affecting the operations of a business. We affect both the returns and the risk, but we don't affect operations. So think about this. If you're a captain of a ship or a crewman on a ship, does the fact that the company you work for has borrowed a lot of money to buy that ship, or has chartered the ship, or has used stockholders' equity to buy the ship, does that affect the operations that you're in charge of? Probably not. And it probably doesn't affect the income that you generate either. It's a financial structure. It's important. It obviously has lots to do with whether the company is long-term viable and so forth, but it really doesn't affect operations. So it's separate from that. So it can be engineered without affecting operations. So a couple of things to realize. Long-term debt is generally more expensive than short-term debt. So if I borrow money long-term, I usually pay a higher interest rate than if I borrow money short-term. So that's because long-term debt is riskier for the lender. So the lender generally demands a higher interest rate. And why is it riskier? It's riskier because the lender is lending the money for a longer period of time, which means they have to predict your solvency and liquidity for a longer period of time. And the longer we're looking at something, the more risk enters the equation. The chances of the outside environment worsening and making it impossible for you to pay the debt back and so forth increases the longer the time frame is there. So long-term debt's more expensive than short-term debt, and risk is higher if liquidity ratio is low, and risk is higher if the solvency ratio is high. So those are kind of things we should know. And the financial goal, what any financial manager is trying to do, is to find the best balance, the golden mean. Where does risk and return get balanced? How much risk am I willing to absorb in order to get at a type of return, a level of return? So I'm going to demonstrate here with a model, and then your assignment this week, and it is a graded assignment, will be to create or analyze. Analyze what? Well, we'll talk about the assignment when we get to the assignment. But you're going to do essentially what I'm going to show you here. We have a model that I'm going to show you. The model says profit for operations is constant. What I do financially is not going to affect my operational profit. And in this example, long-term debt costs 7%, and short-term debt costs 5%. And just so that we can compute return on equity, and I'm only providing you with 1 year of data, average equity is assumed to be equal to ending equity. So that's just so that you can do the ratios. And here's the base scenario. We have current assets of $50,000. We have long-term assets of $150,000. So we have total assets of $200,000, or if we were, and maybe it's 200 million if we're dropping some zeros here. It doesn't really matter. We'll use thousands. So total assets of 200,000. We have current liabilities of 70,000 and long-term liabilities of 60,000, and those are considered to be debt, so they're all interest-paying liabilities. So 70,000 and 60,000. So total liabilities of 130, equity of 70, and total liabilities and equity of 200. So my balance sheet balances, I have total assets of 200, total liabilities and equity of 200. I can now compute the ratios for those things. So my current ratio, current assets divided by current liabilities, is 0.71, which is a relatively low current ratio. Below 1 is considered to be low. It means I have more current liabilities than assets. So that's where my current ratio is. And my debt to equity ratio is 1.86. So I have $1.8 of debt for every dollar of equity, which for many companies would be a relatively normal debt to equity ratio. And my return on equity, so my equity is $70,000. If you look up on this column over here, you've got profit of $7,300. My return on equity is 10.43%. So those key ratios, current ratio, solvency ratio, debt to equity, and return on equity, are all given, and the net profit is given. And you can see short-term debt, 5% times 70,000 is 3,500, and 7% times 60,000 is 4,200. So pretty simple numbers, and we know a little bit about this company. So what can we do to this company? What happens to this company if we change some of these numbers without changing the totals? So we're not going to change assets at all, but we're going to change our liability mix. So we're going to increase long-term debt and reduce short-term debt. So we still have $130,000 in liabilities, but instead of the 70-60, we have 30 and 100. So that's going to affect some things in my equations. And what it's going to affect is my current ratio, my income, and my return on equity. It doesn't touch debt to equity because my total liabilities don't change. So it's going to affect my income because short-term debt is cheaper than long-term debt. So I've reduced my short-term debt. Now I have 5% times 30,000, or 1,500, is my short-term interest. But I've increased my long-term debt, which is more expensive. So I have 100,000 times 7%, or 7,000. Total interest expense of 8,500 now, and net profit of 6,500. So my profit drops almost 11%. However, my current ratio now is pretty liquid. I go from 0.71 to 1.67. So I'm definitely a more liquid company, a lower risk company, but I've given up 10% of my earnings. So therefore my return on equity has dropped 10% as well to 9.29 from 10.43%. So I've done a little bit of financial engineering. I've made myself more liquid, lower risk, but I've cost myself money. Cost myself earnings and return on equity. Okay, so now the next one, I'm going to do some different kind of financial engineering. I'm going to increase my short-term debt and reduce my long-term debt. This has a different impact. It increases my earnings, but it also increases my risk. So I now have 120,000 plus 10 and 10,000. So I've taken 50,000. I borrowed a net additional 50,000 short-term, and I've paid off my long-term debt. 50,000 of long-term debt. So now I have 120 and 10. Notice this still adds up to 130, or we wouldn't balance. So I haven't changed my balance sheet. I've just shuffled my balance sheet. So my current ratio now, current assets divided by current liabilities, so 50 divided by 120, it falls. It's now 0.42. That's getting down in a pretty risky range there. Debt to equity doesn't change at all because my total liabilities haven't changed. However, my income goes up because I've substituted cheaper money, short-term money, for more expensive money, long-term money. My long-term interest goes down, my short-term interest goes up, but overall, my profit goes up because my overall interest is down. So now I'm going to earn 13.7% more, and that translates into an 11.8% return on equity. All I've done is do short-term instead of long-term, or long-term instead of short-term. I'm just balancing, and you can see the risk number here changes, and it changed on the last scenario in the other direction. We got more liquid, now we're getting less liquid. Does this affect operations? No, it doesn't affect operations. It doesn't affect operations unless the risk is realized, unless I can't pay my short-term obligations and I end up going bankrupt. But if I don't, operations continue, and they continue earning money, and in this case we've assumed 15,000. Okay, another possibility. I'm going to reduce solvency but increase return on equity. So what am I going to do? I'm going to increase my long-term debt and use the money I raise from long-term debt to buy back stock, thereby reducing equity. So I'm increasing long-term debt by $40,000 and reducing equity by $4,000. So now my liabilities change. My total liabilities and equity stay the same, but I've shuffled once again between a couple of different things. So I've increased this one and decreased this one. What does that do? Has no effect on the current ratio because I didn't touch current liabilities or current assets. It increases my debt to equity ratio dramatically because I've both increased debt and reduced equity. So I changed both sides I changed the numerator and the denominator here. So big change. So now my debt to equity ratio goes to 5.6, which would be considered pretty risky. My short-term interest stays the same. My long-term interest goes up, so my profit drops a lot, 38%. However, look at what happens to return on equity. Profit's down, but my stockholders are doing great. Instead of earning 10.4% on the money they have invested here, they're now earning 15% on the money they have invested. So they're probably pretty happy. In fact, that profit went down, profit per share went up. And that's what stockholders care about. They own a bigger share of the company because we've reduced the amount of equity investment. So here, return on equity goes up. Solvency becomes much riskier, much less sure. So we've increased risk, but we've increased the return to our shareholders. And then finally, I can go the other way. I can get even more risky. I can reduce liquidity, reduce solvency, and increase return on equity. So I can borrow short term and buy back stock. Whoa, that's really risky because look what happens. Our current ratio goes to 0.45. Our debt to equity ratio goes to 5.67. But we make more money than we did in the last scenario, still less than we were making to begin with. But my return on equity goes to 18%. All possible scenarios. One more scenario I don't have an example of. One more scenario would be to sell more stock, to increase from 70 to let's say 100, and use the proceeds to pay down either short or long-term debt. That will change the ratios once again. It will increase profit, but it will reduce return on equity. It will increase solvency and or liquidity or both. So lots of things you can do. None of these affect operations. So at the conclusion of this, no questions to follow this, but there is an assignment. And the assignment is giving you a fictitious company and asking you to go through those what ifs. What if I do this? What if I do that? And then make a recommendation to the board of directors as to what you, as the CFO, recommend that the company do. There is no right or wrong answer on your recommendation. It depends on your assessment of risk and reward. And I would expect that different students will have different risk and reward triggers. So some people are more risk averse and some people are less risk averse. So you have a possibility of doing any number of things. I want to see examples and I want to see your narrative as to which one you choose, what you would say to the board. Now remember, this is going to the board of directors. It has to be formatted well. It should look probably not unlike what I've done here. But then finally at the end you need to have a narrative as to here are the possibilities, or maybe it's at the beginning probably more appropriate. I've given you the what ifs, board members, and here's the what ifs we could do, and this is what I recommend because. And that's what I'm looking for. So this is a graded assignment, and it's due